Hello, guys. It's good to be back. How are you? I trust you're doing great. All right. A lot has happened in the market in the last few days, and then we have seen significant or strong response in the market on major asset classes, on the DXY, on the US stock market, on Treasury Bond Yields as a result of CPI release. So I want us to look at what has happened. I will tag this comment or this content market commentary because it's really going to be focused on fundamental events rather than technical. All right, so there were two major releases on that Tuesday. On the 14th of November, we saw CPI and then Core CPI. What are the difference, or what is the difference between CPI? Though they are similar, but they have little difference. The difference between CPI and Core CPI is that CPI, which means Consumer Price Index, is a measure of the cost of living of an average consumer. That is the cost of buying food, cost of buying, that's the change in the prices of these items, commodities, food, energy, electricity, and other basic necessities of life by consumers, average consumers. That is CPI. While Core CPI exclude food and energy from the equation. Core CPI tends to focus more on more stable commodities, more stable necessities of life, rather than the ones that are volatile and subject to frequent price fluctuations. Food and energy are subject to frequent price fluctuation, and that is why it is not in core CPI equation. So core CPI tends to provide a more stable perspective of the trend, while CPI provides a more volatile and unstable perspective of interest rate. All right. So what we saw on Tuesday was a decrease in interest rate. What we saw on Forex Factory, what you always see on Forex Factory, had a rate of change, not the actual interest rate. So after the calculation has been done, they give us the rate of change, and that is what you see on the Forex Factory. So, but the actual interest rate was about 3.4 and 3.5, or 3.2 and 3.3. So on Tuesday, the CPI was at 3.2%, and which was slightly below the market consensus of 3.3%. And that was why we saw that rate of change. They saw that, okay, probably there was going to be an increase. The market said that there was going to be an increase of 0.1, while here we had a decline of 0.1. And so when you subtract it from the consensus, you have 0.0. And that is actually the actual. For the core, it was registered at 4.0 percentage, and which was also better than the forecasted of 4.1. Because whenever interest rates drops, it's better. Whenever it goes high, it's not good. All right. So what did we see? These interest rates triggered a strong response in the market, leading to gains in the US stock market, leading to depreciation in the value of US dollar, leading to a decline in the Treasury, bond yields. I will show you the chart of US dollar and then that of the stock market, which is the S&P. For US dollar, we saw on that very day when the data was released, we saw a sharp drop in the value of US dollar. And then we saw a rise in S&P from here. It rose. If you check the date for 15th, and it rose. So why do we have this? Of course, the markets will always respond to economic events, and interest rate is a major event because it measures inflation. What is the relationship between interest rates and inflation? Having explained what core CPI and CPI is, what is the relationship between interest rates and inflation. All right, please pay close attention. I want to make this as quick as possible. There are different types of interest rates. There is a nominal interest rate and there is the real interest rate. The nominal interest rate is the real interest rate plus the expected inflation. Please take note. Nominal interest rate N is equal to the real interest rate plus expected inflation. In the simplest possible words, the nominal interest rate actually measures the return on financial investment. Return on financial investment, the money, the gain on the money that is given for investment. When a money is given for an investment, the return, the interest on that capital is nominal interest. And of course, every investor will always want to make money, all right? The real interest rate is nominal interest rate adjusted for inflation. It is actually the return on economic investment. This is not only confined to financial investment. It has to do with the standard of living and the state of the economy. That's the real interest, and that is what determines inflation, not the nominal, because every investor will always make money. So if the interest rate is higher, it doesn't mean that there is inflation. Of course, it just shows that investors will always want to make money. So the real interest rate is actually the measure. It is what measures the pulse of the economy, and that is the true measure of inflation. While expected inflation is just the rate of change in price over time. So it has to be price last year minus price this year, then you look at the rates, and then that is just what expected inflation is. There is a positive relationship between expected inflation and nominal interest rates, while the relationship between the real interest rate is negatively correlated to the expected inflation. Why do we have a decline why do we have a decline in the value of the US dollar when inflation data improved? There's an improvement in inflation data, right? Which means that the interest rates reduced. When interest rate reduced, what happened? The expected inflation, which is an expectation now. When this reduces, then this will go up. And when there's an inflation, of course, for the CPI, like I said, CPI is just momentary, it's not long-term. It is the core that is more long-term. Now, when you put both together, they form this, because core and they form the real inflation data, all right? That's real interest rates, which actually, helps to gauge the inflation of the nation. So, when this reduced, then this went up. There was a decrease in interest rates, and then leading to an appreciation in inflation. And because the expected inflation is expected to rise, leading to a decline in the value of dollar, because when there is an inflation, there are more money in the economy chasing fewer goods. If more money is chasing fewer goods, that means the value of that money is not much. That is why you need to stack it to buy something small. So, in response to that, the value of dollar dropped. And that was why we have this drop in the value of dollar. I believe this is clear. All right, I won't take much time. I want to make it as short as possible. So, what do we have on gold? What is the effect of what is happening on gold? You know that the relationship between US dollar and gold is inverse. inverse in the sense that US dollar is considered as a safe haven. Gold is also a safe haven. Both of them are performing that role, but in different economic scenarios. Investors tend to gravitate towards dollar whenever the whenever the economy of the US is booming, whenever they see an opportunity, of increase in interest rates, right? If there's an increase in interest rates, that means you are going to make more money, right? You are going to make more money. And if there's an increase in real interest rate, which is the real interest rate, not in nominal or so, if there's an increase in the real interest rate, which is the pulse of the economy, that means the economy is doing fine. Investors will bring in their money. But when the real interest rate drops, then there will be flights to gold. And what happens what situation, what economic scenarios brings this about? Number one, chaos. Chaos, war, like we are seeing in Gaza, because US is a world superpower. If there is a war, most times it has to do with them. It's directly or indirectly involved them, maybe one of their allies or so. So in that situation, it affects the investor's outlook on US dollar, because US would, in one way or the other, try to help out their ally. And because they are pumping money, into ammunitions and all of that, it will definitely affect the economic performance. So investors will fly to gold. So it has been observed that during time of war, gold tend to appreciate in value against dollar. And we have been seeing on gold lately how that has actually played out. Gold has been appreciating in value against dollar. On the 14th here, we saw that move. When the data was released, we saw that rally, and since then it has been moving. So what we saw is that a rebound, gold rebounded after a weakening of the US dollar here. And then the resistance zone, $2,000 per ounce, has actually held price in 3 consecutive areas. It has held price here, in this zone, in this zone. It has held price in this zone. It has also held price in this zone. So there is possibility of it holding price here. However, from our technical analysis perspective, we know that gold is likely going to, break out of this, resistance. But that is subject to fundamental releases. So what is our anticipation? We are anticipating that more economic releases would cause gold to break out of this zone. Why? Number one, the US dollar. The US actually is in great debt. The debt is mounting debt of the Western economy, especially the US. Number one, the current US government debt has surpassed $33.7 trillion, and is projected to, increase by another $1 trillion in the near future. That's $1 trillion in the near future. And then this is like a critical decision moment for the Fed. And then it can bring about potential fiscal challenges, and which will create favorable condition for gold to rally. Because when an economy is in that state, it will affect the currency, and then it will give gold the opportunity to break out of this zone. So in the long term, we are expecting that more fundamental releases, especially by next year. We are expecting the Fed to do what is called quantitative easing. Let me just explain what that means. Quantitative easing is an unconventional monetary, policy. We have conventional, unconventional. Quantitative easing is unconventional in a situation in this kind of situation where the economy is at the point of collapse. The Fed would pump in money into the economy, in the sense that they would encourage purchase of assets which will increase the money supply into the economy. That's number one. They would also aggressively reduce the cost of borrowing, which is the interest rate, right? And when interest rate is reduced, if you know that what you are going to pay on the amount you have borrowed is minimal, you would keep borrowing, right? So, and this would have a positive effect on the economy because people will be, forced to borrow to invest into the economy. So investors will come in from the economy, right? From the country, they borrow and they invest into, productive activity in order to bring the economy out of mess. So, and the intention of quantitative easing is actually to stabilize the economy. So, we are expecting that by May of next year, the Fed may actually, we may actually see what is called quantitative easing in the U.S. economy. And then this is actually to salvage, because there are a lot of things happening. The war, pumping money into Ukraine, Gaza, Israel, and what have you. So, what are we now? I believe this is clear, but let's look at the US dollar. Maybe there is an insight we could also draw. This is the S&P. So this is a momentary rally, which is caused by that the stance of the Fed. But let's look at. So I believe this is clear. This particular explanation using this formula is clear. So we may see further decline in the price of dollar to this region. We may see that, and then if that is the case, then gold will still keep appreciating in value. So I think that is all for today's market commentary. I hope you have value for this content, and then I wish you all the best in your trading endeavors. Bye for now.